What up, what up? 5 o'clock Eastern means it's another all-new edition of What Are Your Thoughts? John is in charge tonight. Daniel's here.
Dude, I just gave John a chart at 458. Yeah. No problem.
Dude, John's a beast.
Legend.
John's been holding us down. Hey, shout out to everybody that's here for the live chat. By the way, Daniel too. John and Daniel controlling things. Everything's going to be great. Hey, I wanted to say hello to some folks really quickly. Sean Graylish is here. Speedrunner. Zoe is back. Donna Ski. Hi, Donna. Nick Ramel is here. Roger and Magnus. John Carlo. Jerry Gould. Everybody's here, Michael. You excited? You fired up for this?
Absolutely. It's a big show tonight.
So I was thinking, yeah, we got a lot going on. I was just thinking one day you and I will be doing a podcast with someone else, and it won't be going well, and I will demand that they bring in Michael Batnick.
What do you mean?
The way that Aaron Rodgers was able to wave a wand and get Devontae Adams back, which I kind of respect his gangster. Basically, like, if you don't get me my receiver, this is not going to work. I can't be throwing Hail Marys for 45 minutes every night. Why do the Jets play in primetime every week? Did they do that on purpose this year? What do you think that's about? Why do I have to watch them on night games every week?
That's not. No. They played the Vikings in London, then they played the Broncos. Definitely not in primetime. I think your recency. That's called recency bias, sir.
Did they just play a Sunday night and a Monday night, or am I dreaming that? Or a Thursday and a Monday?
Last week, there was a Thursday. I think they played Buffalo on a Thursday. No, they played. I don't know. They played a Thursday.
Played Buffalo last night.
Yeah.
It's
either way.
So the thing is, I really like Aaron Rodgers, and I don't care about the Jets at all.
You really like Aaron Rodgers. You're the one.
No,
nobody
I
do. Nobody likes Aaron Rodgers.
I like him. I think he's nuts, but I kind of like that energy. I like how he loses a game and then goes on a podcast the next. He cracks me up. Oh, the funniest thing he ever did when they all had to get the vaccine, and they asked him, "Did you get a vaccine?" He goes, "I've been immunized."
So did he? I don't know. I don't.
He did. He went to some like voodoo ceremony, and that was good enough. All right, we have a sponsor tonight. Thank you so much to our friends at WAYT Charts. Michael, what do we want to say about WAYT Charts?
So not only does WAYT Charts give me all of the data that I need for everything, economic data, stock market data, fund data, model portfolios, the whole kit and caboodle. Is it kit and caboodle?
Yeah, you got that right.
Okay.
You did that one good.
Okay. They also put together some pretty killer research. So I don't know if you know this, Josh. There's an election coming. There's interest rate cuts coming. They've got you covered. If you're not sure where to go to WAYT Charts. If you're a new listener if you're a new customer, you'll get 20% off. Tell them we sent you.
Yeah. So how do you get 20% off with WAYT Charts?
I just told you. You're not listening? You tell them that we sent you.
But we have our own URL. Is it a custom URL?
It's custom. It's custom. Right. It's like Aaron. It's been customized.
Just go to WAYT Charts. Tell them Josh and Michael sent you. WAYT Charts is indispensable to us making the show, as you guys are about to see. All right, you're in charge tonight. What's going on? Okay.
So the bull market turns 2. Although, does it though? Because last week we would say like... But seriously, so, okay, here's what we can say. Definitively, not an opinion. The market bottomed 2 years ago today. Okay? That's what happened.
I'd say it turned 2. Let's just say it turned 2.
All right, okay. The market's 2. That feels good. So, as everybody remembers, we spoke about this a lot of the time. Nobody was bullish. And I'll say, hand up, I wasn't exactly pounding the table to buy stocks. I'm pretty sure I wasn't. And so Callie, our chief strategist, put together some good charts just looking back on how market participants felt at the bottom, and they didn't feel very good. Chart on, please. This is the American Association of Individual Investors, and that might be the first time I've ever said those 4 words without tripping all over myself. This is the poll that basically asks people, are they bullish or are they bearish? Do they expect the market to be higher versus lower? And we got to an extreme in the bottom of 2022, and as is so often the case, that was pretty good for a bottom.
You know what's leave this up for one sec. You know what's so funny about this? So you can clearly see now, not just in hindsight, but even in that moment, you could see that the amount of respondents to AAII who said that they were bearish was, in that moment, extremely extreme. But the thing is, and this is why this is so hard, that number had been going lower and lower and lower, and it was already extreme 4 weeks before. So, in other words, it didn't act as like a great signal for bulls the whole way down, and it had remained extreme for a while.
Correct. Yeah, if you zoom in, you're right. If you zoom in,
It's not like it was one extreme week. It was an
Nah.
extreme year.
Yeah.
You know? So that's one thing about it. And then, like, the second thing is, whenever it hits that extreme, it doesn't hit an extreme bearish reading in a vacuum. Like, things are bad when it hits. Things are bad and they seem like they're getting worse when it hits that extreme. That's how it gets there. It's not like it's a sunny day and it's like a couple of lunatics running around with an umbrella.
Right.
Things are bad in that moment. And I think that's, you know, it's so easy to look back at that and say, oh, look how dumb everybody was. No. There was unanimous agreement that we were headed into a recession in that moment.
Morgan said something like every previous panic seems like an opportunity. Every future panic seems like a crisis.
100%.
Something like that. And it's true because, yeah, stocks don't go down 20% for no reason. They don't go down 30% for no reason. Things are really fucked up, and it was. And so we talk about this current bull market, and we're going to get to that today. But it's easy to forget. We were in a bear market for 2 years, and your favorite names, almost all of them, maybe not Microsoft, but all your favorite names got cut in half and worse.
Crash.
Amazon, Google, Meta, Netflix,
remember Meta?
NVIDIA, down 75%. 75!
Yeah. That was the worst one.
75!
Meta was the worst of the fangs off the high.
Horrendous.
It was brutal.
Horrendous. Okay, next chart. So how does this current 2-year recovery from the low stack up against the other previous bull markets since 1970? Where's the line? So it's the big, thick blue line, and it looks like it's like middle of the pack.
The light blue line. Yeah,
Right?
it's average. It's an average. It was 65%?
Yeah.
Ish on the S&P. I know the Nasdaq's more. The Nasdaq got hurt more, so kind of makes sense.
Some data from Cali. On October 12th, we closed at a 2-year low, and since then, the S&P is up 62%. Since 1932, bull markets have lasted an average of 4.4 years, yet only 9 of 16 bulls live to see their third birthday. Interesting. If the Fed applies the right touch to the economy, Cali says, we could be in for more good years ahead. With an average annual gain of 38% in the bull market, the bigger risk has often been missing out on the bull rather than buying right before market peak.
Can I? All right, I read her piece. I should have asked her. An average annual gain of 38%? So, really?
Is that right? Oh, I did just say that, didn't I?
Yeah.
What?
I think I know what she means. Like, she's counting, like, the whole, like, the recovery, like, in 2009, didn't the market run up, like 35% or something as the recovery from the low?
To when? Yeah. So at some point,
No,
35%.
till infinity, till now. I'm just saying, like, in a real bear market, you have like these huge, you have these huge gains that form the bottom. Usually, they don't like gradually recover. So, all right,
chart genius, Matt. Sometimes he's chart kid, chart boy,
still chart kid,
chart goat. Made a chart showing the sector contributions to this very nice 69% gain total return since the bottom. And yeah, a lot of it is tech. I mean, no surprise there.
Yeah, of course. And why wouldn't it be tech? Because if we made this same chart and instead of stock price gains, we did earnings growth, guess where the lion's share of the earnings growth would be. This chart would not, in my best estimation, would not look materially different. I think the gains in the sectors would roughly line up with the gains in earnings.
Perhaps even, yeah, for sure. I would say perhaps even like the gains in the earnings might even be more so than the gains in the stock price. Sean Russo shared with us a crazy face blower of a staff from our friends at OSAM. He said the R&D, the research and development from tech on a percentage basis is higher than the profit margins for 6 of the 11 S&P sectors. So, said better, tech is spending more on a percentage basis of their revenue than the profit margin for 6 of the 11 S&P sectors. Is that out of control?
Yeah. So assume they're not just lighting dollars on fire. Guess where? Guess where the earnings growth will materialize next year and the year after.
So we were talking about the AI thing, the tech trade, and I was listening to Joe and Tracy and the guy from Apollo talking about how AI is impacting the private credit market.
Yeah.
And he made a really good point that's not lost on anybody, is that if you're looking for like froth or signs of exhaustion or leverage or people are tapped out, no. You think Amazon is going to, or Google's going to run out of money to keep this party going?
Yeah, that was a really good point. I listened this morning. That was a really good point. And the concept was, sure, it's just like the dot-com bubble, except the dot-com bubble was fueled by IPO money.
Right.
This thing is, this particular wave of tech spending is being funded by a combination of the U.S. government via the Inflation Reduction Act and several stimulus programs for the CHIPS Act, et cetera, and the most well-capitalized companies in the history of the world: Apple, Microsoft, Amazon, Alphabet.
How much cash does
not
Apple
IPO
have?
money?
How much cash does Apple have on their balance sheet?
I don't know, 200-ish.
They have a long runway.
Billion, earning more every day. So it's a really important point. So it's $1 trillion build out or whatever for everything from GPUs to the buildings they're going to put the GPUs in and the power that's going to provide electricity. And it's not being spent by funny money. It's not IPO. There are no IPOs. This is coming out of the cash flows of the most profitable companies in the world. I thought that was really important.
Chart back on, please, John, for a second. We're going to get into this in a minute, but the sector one, if you don't mind. Thank you. So communication services, again, that's tech, that's Google and Facebook. So that's 40% of the rally. But look at financials and discretionary and industrials coming up the proverbial rear.
Yeah, we're going to talk about financials in a little bit, so I don't want to step on that. NVIDIA hit an all-time record high yesterday. It hit 138 or so. At 70, it was the next Cisco. I don't know if you remember that. It's doubled since the Cisco comparisons were. It's doubled. It's blown through that. Apple hit a new record high, and Apple has not particularly had great news flow this year. 20% of their sales come from China.
I gotta be honest.
This doesn't make
great. This doesn't make sense to me. The Apple stuff. I'm not sure what's the story here. Why is this not?
I just got out of a thing with Alex Kantrowitz, and that was what he asked. Or was it Alex?
Yeah.
Is that who I was talking? Yeah.
Did he say why is Apple an all-time high? Honestly, I have no idea.
Well, the reason is that I think they get the benefit of the doubt as long as the cash flows and the earnings are there, and they are. And Apple just, all right, sell our stock. We'll buy more.
Benefit of what doubt? That they're going to figure out the AI thing?
Yeah, because the AI launch was not great. It's an open question about whether this phone upgrade cycle is going to stack up well against the last few. And they had a huge product flop a year ago, which we're going to talk about later in the show as well. The news flow for Apple is between China, the product not hitting, and now the iPhone AI thing kind of being a little bit of a stumble, maybe out of the gates. Why is the stock making new record highs? The answer is the earnings are still there, thanks to services, and people are going to give it the benefit of the doubt. Listen, it's not a cheap stock. Nobody thinks it's a cheap stock. The other thing that you could say is when there's a wall of money coming at equities at an all-time high, Apple is in every index ETF. It's like it's in every ETF that's taking in capital.
All right,
and
counterpoint. Apple's been in every ETF, in every whatever. It's been the biggest. In April, the stock was getting hammered. Rightfully so, because the business wasn't performing. Nothing really has changed since then, except for the fact that it's now 35% higher than it was in May, dude. Yeah. It was 170. Now it's 235. Nothing changed.
Yeah, counterpoint. How long was it in a drawdown? Not long. They buy this stock.
You're right, not long.
They buy this stock back fast, dude.
It peaked in December, bottomed in May, and off to the races.
Yeah, that timeline also coincides with the first sales from Berkshire Hathaway. They still own a ton of it, but they were a size seller. I wouldn't be surprised if they're selling even more right now, actually, into a record high. What's the multiple? What's the multiple on the stock? Is it
way higher? 35? Way higher than I was about to say. Way higher than it should be. Who am I to say what the multiple should or should not be? But it's high.
35 times is not the multiple they bought it at. So
no,
we know that. All right, I want to talk about the VIX a little bit. This kind of I I don't know if this is subsiding, but there's a lot of chatter over the last week about that. And I don't know where this thing started, but people were pointing out that it's really strange to have the stock market at an all-time high at the same time that you have a slightly elevated VIX, meaning people are in the options market buying protection against a near-term correction in the market while the market is making an all-time record high. And there were a lot of people saying this is weird, or you don't normally see this kind of thing. So my take on it is it's entirely related to the election. The election falls within the next 30 days. The election is obviously a time where if you were to see some sort of gappy, kind of dislocaty activity, it would be now. And therefore, it makes sense that people are in the options market buying protection. And that's kind of like how you can wrap your head around why are we making record highs while the VIX is climbing alongside stock prices. So
can I say one thing? Hold on. I wish
please.
I did this. So I used to make this chart of the rolling 30-day return of stocks overlaid with the VIX, and it lines up pretty damn well. There's definitely divergence right now.
Yeah. Yeah. No, it's not. Listen, it's an interesting thing to point out. And we did a couple of things. We took a look back at, like, is this so anomalous? Do we really never have a rising VIX for the rising stock market, or a rising VIX at an all-time record high? So let me show you a couple of charts.
Okay.
This chart kid Matt. The dots are representing when we're in a bull market, and the VIX is above 20. Do you see a lot of dots here, Michael? I do. They're all over. This is like sprinkles on an ice cream sundae. It's all dots. So the VIX is above 20, 26% of the time when the S&P 500 is in a statistical bull market. A lot of people would not guess that this happens this often. It turns out that it does, and it's not necessarily indicative of a turning point.
Wow, I can't believe Matt is calling 2009 a bull market. He doesn't listen to us.
Yeah. All right. Here, 2. S&P 500 with dots representing when we are making new all-time highs, and the VIX is over 20. There are 103 instances of this back to 1990, so it's not 0 times. The average 12-month forward return when this happens.
But wait, it is fairly rare. It's fairly rare because from 2003 to 2007, it didn't happen a single time. From 2009 to 2019, it didn't happen a single time. So it's not unprecedented, but it's pretty abnormal.
Yes, but let me finish because this is really the main point. It doesn't matter if it's rare or a little bit rare or not rare at all.
Medium rare.
Medium rare. No, I think what's important here is it's not a death sentence for the rally. So this has happened 103 times where we've had all-time highs and a plus 20 VIX. The average 12-month forward return is 16%. The median 12-month forward return is 18%. Those sound like better than normal for a 12-month period. And the win ratio is 89%, which means almost all the time when you have a higher than 20 VIX,
don't come here with
and
this
an all-time
nonsense.
high.
This is nonsense. Sorry,
Why?
I love Matt, love you. It's just nonsense because it happened. It happened in
100 times.
It happened
dude.
during the Asian contagion in the late 90s, and then it happened. It happened during the pandemic. So come on, next time, who gives a shit? It's twice.
Right, but these things are clustered together. But that's always the case. We don't have 10,000 years of data.
Exactly. Throw it out.
We have what we have. We have what we have.
That's true. We have what we have.
Let me ask you a question. This is unscientific. From what I've seen and read, it seems as though the same people who were bearish because of concentration in the market have now converted over to they're bearish because the VIX is rising as the market is peaking and or as the market is making new highs. Is it sort of the same type of people?
I don't know. I have freed myself from that aggravation. I really, truly don't know.
Okay. I want to show you some stuff from Andrew Thrasher on this same topic. Thrasher is like a VIX Jedi, and he does a great, I don't know what to call it. It's kind of like a monthly thing, maybe. Maybe it's more frequent, but I only get the monthly. But he does a lot of work on whether or not you can predict an earthquake in the market using the VIX.
Oh yeah, that was a good one.
That's his big thing. Is like
he's a VIXologist.
He's a VIXologist, and his big thing is like, no, you don't want to react to like normal volatility. You want to pay attention to when there's something seismic happening beneath the surface. And I think a lot of people think that way. But Andrew actually does the work on it. And here's what he had to say about the topic. A big topic over the last couple of weeks has been the elevated VIX. This is partially due to the upcoming U.S. election. But I took a look at this week at the data of when historically the VIX has been above the 25th percentile. There's been just a handful of instances, and the majority did lead to a short-term pullback. The median loss has been relatively low, but it's something to be aware of should we start seeing any weakness in equities. Chart 1. So he says this is concerning for equities, the elevated risk. Part of why it's above 20 is the election is within the window. But we rarely see the VIX at such a high percentile when the market is at a fresh high. The study shown below notes a red arrow when the VIX is above the 25th percentile. Currently, it's at the 32nd percentile as of the time he published. But now we're going to show you the median reaction to the S&P 500. Chart, please. Okay. Here's a look at the median change in the S&P since 2004 when the VIX is above the 25th percentile and the stock market's at a 52-week high. Only 12 occurrences, Michael. The equity index was lower 63% of the time 15 days later, but the median return is only 1.5% negative. So it's not that it's not a concern. It's that, come on, what are we really talking about when the median drop-off from this type of a situation is less than 2%? Mm-hmm. And I thought that was a really important point, separate from what Chart Kid Matt was saying. What are your thoughts?
Yeah, I don't have a ton to add. I think he's right.
Yeah. I think we should have Andrew. We should have Andrew come by sometime soon. It's been a minute.
Yeah, I haven't seen him in a while.
Okay.
Anything else?
Nope.
Nicole is telling me that the chat thinks my TV is huge, and I'm flattered. But
I didn't even notice that. Is that
it's normal
60?
size? It's normal size.
70? What is that?
No. I think it must be the angle. It's.
Oh, is it on a what's that kind of arm called?
I don't know. It's not that big.
Has
it's
a name. Somebody in the chat. What is it called when the arm can do that?
Swivel?
No, is a better word for it. Something like meticulating arm or something. Have you ever heard of that?
I have not. Let's talk bank earnings. So it was an interesting
articulating arm. Articulating. Thank you, everybody. All right, go ahead.
So I grabbed this in the middle. I grabbed this chart around 2 o'clock. It was a weirdish day where the large cap growth was getting hammered. It was primarily all chips. Look at all that blood red. NVIDIA, Broadcom, AMD, Texas, just Applied Materials, just nasty stuff. Oh, United killed the Dow today. Energy stocks had a bad day.
United Health. One of the worst days for that stock ever.
So it took 300 points off the Dow. I think it was the biggest holding in the Dow, which is kind of hilarious. But anywho, banks reacted positively today it's been a bull market for banks. So let's get into some of the stuff that we saw. You know that, I think I said this last time, Bank of America puts out my favorite chart book, just very representative of the economy. They serve everybody. So I grabbed a few things that I want to talk over. Chart on, please. This is showing the average deposits and rate paid trends. And it breaks it down for listeners into corporate, consumer, global banking, and global wealth and investment management. And the thing that I want to highlight is the total rate paid, which is the gray line in every chart. And you could see that it is, the steepening obviously is in the past. The steepening killed bank earnings.
This is the rate that Bank of America pays to the customers in these buckets.
That's correct. What's so remarkable, at least to me, is look at consumer banking. You're talking about $1 trillion at Bank of America alone. That was satisfied with 65 basis points, even though a lot of money, $7 trillion went to money market funds. Not enough. People still, there's $1 trillion earning 65 bips at Bank of America alone.
I guess we don't know if that's savings or checking accounts. Like, is that money that's just perpetually in motion in people's checking accounts.
Could
like
be. Now,
they pay a bill, it comes back in, and it looks like it's just sitting there, but it's not.
The thing is, they have so many customers that you could be talking 900 here, 2,000 there, but nevertheless, it's still so much money. But anyway, it is important that the total rate paid has flatlining and will start to come down as the Fed continues to cut. All right, next chart, they show digital adoption. And the thing that I want to point your eyes on or your ears on is the bottom right chart. The check deposits. I think we spoke about this, or Ben and I spoke about this, but this is a real face blower. So 68% of checks are deposited digitally. That's how I do it. I get a check, I take a picture, at least at JP Morgan Chase, boom, into my account.
Same.
8% of people go to the ATM. Okay, reasonable. But 25% physically go into the bank and deposit the check, which just blows me away.
That number will be 10% 3 years from now.
Correct. No, it's secular, of course. It's just old people that are continuing to old habits die hard. But 25, one in four checks is deposited at the branch.
That number will just continue to shrink, though. It's so easy. I'm Bank of America, same thing. The app, just take a picture of the check. It's done. You get a record of it. Everyone's happy. What are we doing? What are we doing here?
So I didn't grab.
You know why I go to the bank? I go to the bank though.
I went to the bank today.
I went to the bank twice this week. You saw me go to the bank last week.
I did?
Yeah.
Yeah.
Yeah, we needed a notary. My daughter turned 18.
Oh, yeah.
And we needed to do this thing with her health forms so that, God forbid, something happens, we can make, as her parents, we can make decisions for her. I don't know why all of a sudden we had to do this. It was like an emergency, but we did it. And then the week before that, you need cash to pay people for stuff.
You need cash.
Landscaping,
gotta
tools,
have it. Yeah.
like all that stuff.
That good fiat. All right, so there was another chart in Bank of America's earnings today, which, by the way, they beat on the top line and the bottom line. And I didn't grab the chart because I just, for the sake of time and moving on. Total loan volume, it's really not growing. Not really growing that much. It was like 1% growth. Not a lot.
I'm so glad you said that. It is growing.
Okay.
It's not growing at the banks.
Right. Fair. Okay, we'll get to that.
It's growing everywhere else.
We'll get to that. Okay, Goldman Sachs reported. I think they also beat on the top and the bottom line. Stock closed at an all-time high today. Hell of a run.
This thing looks good, dude.
Kudos to them. Okay, so
Did you pick this as your make the case recently?
Yeah, a couple weeks ago.
I don't own it. You crushed it with this call.
Well, I don't own it, so it doesn't matter.
No, but it was good. It's good for the listeners.
Try it back on. So net revenues versus the third quarter a year ago up 13%. Pre-tax earnings up 55%. That's got to be some sort of one-time thing, I would guess. But yeah, no, Goldman Sachs is doing well. I listened to the call today on the walk home. Kind of boring. Not really a whole lot to say, but
yeah,
there's a lot of brand stuff and
Goldman Sachs is healing.
Yeah,
they're not. It's not like exciting. What's going on is they've gotten out of all these businesses they didn't belong in, and they're going back to what they do better than anyone else on earth.
Yeah, so they got rid of
back to
United Capital, gone.
Businesses.
Marcus, consumer-facing stuff, gone. BlackRock, absolutely killing it. No surprise that they are the market. Grabbed a few quotes from Quarter on their call. All right. We sounded optimism about our growth trajectory in the second half of the year and in the third quarter. Organic growth surged, and BlackRock delivered some of the best financial results in our history. We generated $221 billion of net inflows, our highest net flows quarter ever. And by the way, this is me speaking, not them. The fourth quarter tends to be their biggest quarter. So we'll see what happens next quarter. Getting back to them, we delivered record levels of quarterly revenue and operating income. We expanded our margin by 350 basis points year over year. Pretty damn good. iShares fixed income ETF assets now stand at over $1 trillion, nearly 40% higher than at year-end 2021. And Josh, just two more things, and then I'll give it over to you. Sticking with the ETF thing. This is from Larry Fink. ETFs remained a secular growth driver, adding $97 billion of net inflows in the quarter and $248 billion year to date. We're seeing a broadening of ETF adoption globally, leading to increased levels of utilization, which we believe will only continue. And lastly, our iShares, this is a coup de grace. Our iShares fixed income ETF platform recently crossed $1 trillion in assets, and standalone, it would be a top 5 bond manager by itself. Assets have nearly doubled over the last 5 years, and that's been in a bond bear market.
Yeah. And, well, I'd say three things. The expanded our margin by 350 basis points year over year. How'd they do that, do you think?
I don't think I know. A lot of it is the alt stuff.
Okay, so they're selling a lot of alternative strategies that just pay them more than the iShares suite of plain vanilla index ETFs.
Yeah.
Okay, that's impressive. JP Morgan had the same thing to say. The growth in JP Morgan Asset Management and their ETF business, all that stuff is just absolutely on fire. I don't know whose hide it's coming out of.
Well, that doesn't change. That doesn't change the margins. It's the alt stuff. That's what does it.
Well, no, the mix, right.
Yeah.
So JP Morgan is selling a ton of alternative and active stuff in the ETF category, and BlackRock apparently is really good at that as well. And listen, if you're a top 5 asset manager and you're in a bull market like this one for both stocks and bonds and alts, you better have something good to say. And they
check this out.
They delivered.
This from Larry Fink. The growth of private markets is underpinned by the continued rise of infrastructure. It presents a generational investment opportunity. By the way, this is the CEO of the biggest asset manager firm in the world. Like, do not take this lightly. He just said it presents a generational investment opportunity. Over the next 15 years, we'll need to invest $75 trillion to repair aging infrastructure, to invest in new projects like data centers, decarbonization technology. The current cash flow, inflation-protected return profile of infrastructure makes it an attractive sector for our clients. He spoke about private markets, of course, have been mainly okay. Whatever. We don't have to get to all that, but it was a lot of private market stuff.
Well, BlackRock's going to be one of those gateways to this kind of infrastructure investing that institutions want to do, hedge funds want to do, private equity wants to do, sovereign wealth wants to do, regular wealth management wants. Everybody wants to be part of the run. And again, I agree with what you just said. Like, this is Larry Fink talking.
Yeah.
So you might
pay attention.
You might be one of these fucking know-it-alls sitting on the internet, in your house, and you have a view on the sentiment appears frothy. Dude, they're spending actual dollars. Like, this is not conjecture. This is the money that's going into these types of investments.
So they spent, I think, $11 billion is a number in my head, to buy global infrastructure partners. Here's what they said. Here's what they said on the call today, or yesterday, whatever it was. We're doubling private markets run rate management fees at BlackRock. Okay, doubling. In the transaction, think about GIP adding, that's global infrastructure products or partners. As we said on the call, annualized north of $400 million of earnings at 50% margins. $250 million in management fees we expect to come in the fourth quarter. So I'd model sort of $1 billion with an FRE margin north of 50%. So it's meaningful, like really, really meaningful. All right, let's move on to, okay. So Balchunas tweeted this today, getting back to the ETFs. IVV, which is BlackRock's S&P 500 ETF, has now taken in over $51 billion year to date, which if it weren't for Vanguard's absurd, that's VOO's Vanguard's absurd $76 billion, would be an all-time annual flow record. And this is still mid-October. So I keep saying, where is all this money coming from?
People's paychecks.
It's unbelievable.
No,
there's
no other answer.
All right. So Schwab reported decent earnings.
Yeah. Let me take Schwab.
Go ahead.
This is one of the best post-earnings reactions Schwab has had in its share price in quite some time. It's been a really long bear market for Schwab that started toward the end of 2021. They announced the biggest deal in the history of online brokerage when they bought TD Ameritrade, and that deal coincided with the onset of a bear market for both stocks and bonds, and a big interest rate hiking cycle,
and a bank run.
No,
for real.
The bank run is related to the interest rate hiking cycle, but yeah, it's been a winter for Schwab, and they're coming out of that winter. It's still in a downtrend technically, but I think it could break out here because not only have they now probably seen the worst of this, they think they've seen the worst of this. They have a leadership change. So let me read this from the stock popped 6 or 7% today, which is not crazy, but the stock, it's a fairly calm situation. It's not Robinhood. Charles Schwab shares jumped after reporting earnings per share that topped analyst estimates and curbing some of its expensive debt. a sign the firm has moved past the bout of turbulence last year. Adjusted earnings per share for Q3 were 77 cents, which was a beat. Adjusted net income was $1.5 billion, up from last year. Not up a lot, but up, not down. Client transactional cash sweep, which took a hit when customers shuffled funds in search of better yielding options. That was cash sorting, we were calling it. Climbed $9.2 billion sequentially, helping the firm reduce costly bank supplemental funding by $8.9 billion. Here's Walt Bettinger, who is the CEO, outgoing CEO. Some might refer to it as an inflection point. Yeah, I might. Put this chart up. This is good. This is good news for Chuck. Core net new assets, $157 billion. So the money is coming back in, which is nice. That's 17% year-over-year growth. And new brokerage accounts. So they opened about 1 million new brokerage accounts last quarter, 1 million the quarter before. So the business is okay. What's this next chart saying?
I just thought this was a really neat chart. So on the left, we're looking at households under 40 and households under 30. Households under 40 accounted for 56% of total new retail households on a year-to-date basis. Now, I guess that shouldn't be too surprising, given that, listen, if you're 65, you probably have got plenty of accounts at Schwab or Fidelity or wherever you have them. But that's nevertheless, it's impressive. 56% of households under 40 accounted for all the growth.
That pink circled graph is RIAs.
That's RIAs.
So what does that mean?
So this is showing that there's $88 billion in net new assets. Net new assets.
This is year to date.
Year to date. And it's showing that 42% of those flows came from what I would call, I guess, medium-sized RIAs, 500 to 5 billion.
Yeah.
22% came from mega RIAs or large RIAs, which is us, not to brag, $5 billion plus. And then the other 36% came from relatively smaller RIAs.
I was going to say Schwab.
Pretty healthy mix.
So Schwab's net new assets from RIAs year to date through the end of Q3 is a total of $88 billion.
Yeah, dude, it's a monster.
Are we like $1 billion of that?
I would not quite that. Let's round up. Let's be generous. Let's round all the way up.
I feel like Ritholtz is helping the cause here. All right. What's this last one?
What's the last one? Okay, this is a big one. All right, so wonderful charts here. Thank you to the Schwab's corporate investment team for putting this together. So we're looking at cash as a percentage of total assets on the left. That's the blue line. So it peaked at 15% and got all the way down to 9.7%. And by the way, there's no just eyeballing it. It doesn't appear to be. Those are new lows, right? So the cash short now, the slope of the decline is maybe moderating, but it's still new lows. And what are they doing with that cash in 2024? 57% of that is going to buy money market funds. And guess what? That's no bueno. That's not good for Schwab. They would much prefer the 29%, the cash sweep, to just be chilling and let them take the margin. So I do think that, listen, I sell the stock. I don't own it anymore. The cash sorting, it's 98%. I'm making up a number. Most of it is behind us, right? If you were going to get the 5% that was available, well, it's not available anymore. Like if you were going to go, you probably already went.
I think that's right. I think it's a wave that already crashed on the shore. So the water is still coming on, but like we've seen the crashing of that, and rates are already on their way down. So getting 0% sitting there versus 5.5%, is one thing. But if we get Fed funds down to 3.5% and money markets are like 3% or 3.5%, I don't want to move it. So I think that part's the hard part's over. Let me sum up the story here. The opportunity in Schwab going forward from today's price. The story is they are now lapping the quarters of the problems that higher interest rates caused. Done. They went upside down on their long-term bond portfolio. Mm-hmm. People were really concerned with this around the spring of 2023. Like people were very, very nervous about Schwab's bond portfolio. That's less of a problem now. Also, when people were pulling deposits in search of higher yields, not only was that a problem for Schwab's earnings, but they were forced to find other sources of funding because those deposits are effectively how they're funding the business. So they had to get supplemental funding, and supplemental is a euphemism for borrowing at a higher rate than zero. So that problem appears to have sorted itself out. They are not forced to pursue as much supplemental funding as they were, meaning their cost to borrow money is falling. So those were the two problems with the stock. And if those, we've now seen the worst of both, I think you could buy this thing. I'm not in it, but I think they're set up well for a lot of big themes like generational wealth, and the options trading is still going crazy there. And then the other thing I mentioned, Walt Bettinger has done an incredible job, grew this business substantially in his time as CEO. He has now stepped down. The new guy, Rick Wurstler, takes over, and they have a new CFO too. So it's like brand new management at the same time that the problems from the last 2 years are going away. So the major negative still hanging over the stock is they're not growing. It's like they're expecting 1% growth next year or something. So they need to find a new avenue of growth. What do you think they're going to do?
Well, they announced today, I think it was today, a partnership with iCapital to bring alts to high net worth investors.
Also the answer to everything, right, of course.
Shut, can you believe
All right, so they'll do that. I think they're going to do more tax stuff. I don't know what the laws are. They're a bank. But I think they're going to go more heavily into tax. That's my bet.
Nah, that's a shitty scale. That's not scalable. I don't think so.
I mean, to compete with H&R Block and Intuit.
Yeah.
I feel like they're ready to bring it. I also think they're going to get more heavily into advice in general, which has been something they've been doing, and I think they just have to look at that and say, yeah, we'll ruffle a few feathers, but we should be bigger in that business. Yeah, what are you going to do? All right, so if everyone does alts, is it actually an alt?
Yes.
It is?
Yeah.
Remember when you don't remember this, you were probably just born. There was a moment where alternative music was the entire top 40. Alternative rock.
What the fuck was alt music?
Yeah, exactly.
Oh,
Nirvana.
Nirvana? Yeah.
Nirvana was alternative rock. It had the number 1, 2, and 3 albums at the same time.
Wasn't it called grunge?
It was also called that, only for the alternative rock bands that were from the Pacific Northwest, because they all wore flannels.
Soundgarden? Don't tell me I was just born then. How disrespectful.
So if everybody is listening to Nirvana, Soundgarden, Stone Temple Pilots, Blind Melon, etc.,
dude,
if that's the whole top 10, is it alternative? Not really. That was the pop music of the era.
The thing is, the opportunity is 30% of institutional investors' portfolios are already allocated. The juice has been squeezed. The average holding to alternatives for retail investors
3%.
is around to zero. Yeah. So not everybody's in alt. In fact, it's the opposite.
So I'm now in 100% alts. I'm way ahead of my time. All right.
Good for you. All right, let's go. What's next?
Tesla. So this was a bomb.
By the way, you sent me and Chris the link. I was like, dude, what time is it? I think I was in bed.
I'm mentally ill. They were supposed to go live at 10 p.m. East Coast time last Thursday. I was out eating Chinese food.
Where was that? Home? I don't know.
I don't know. I thought you were with Chris last week. I was with my college friends at Nomad Tea Parlor.
Oh, you never answered me. How was it?
Strong recommend. We're going back. Anyway, they were supposed to start this event at 10. They started at 11. They did an hour of mushroom music and like trippy graphics on the screen.
Mushroom music.
Is
that alt?
I think Elon likes the mushrooms, and it was like EDM, but it was like trippy EDM. And then finally, the camera cuts to, or the screen cuts to this like really highfalutin intro, and they're on the Warner Brothers lot, and it's a cityscape.
Why did they do it? Why did they do it there?
Well, they wanted to show the cars in action in what would be a city, but the cars aren't really ready, so you couldn't do it in Los Angeles. So they did it in a facsimile of Los Angeles, which is on the Warner Brothers movie lot.
Got it.
And that way they could take the whole thing over. They had the media there, the tech press, and people seemed excited to be there on screen, but the reaction, like online, was nothing like what I would have expected. People were like, "All right, I guess That kind of looks cool. And then the next day, Wall Street was like, no. Like there were no specifics, no real timetables. They're talking about putting this thing out. Oh, we have some pictures. Maybe let's do the pictures. All right. So that toaster oven thing in the back was probably the coolest thing they showed.
That looks sick.
Yeah, it's a robo van. The design is actually taken or inspired by something that used to exist in the Art Deco era. And Elon wants you to pronounce it Robovan.
No.
He doesn't want you to say Robovan.
Is that from Demolition Man?
Maybe.
That looks sick.
Yeah, it looks cool. It looks cool. Here's the problem. This already exists. Jeff Bezos backed a company called Zoox, and those robo buses or robo vans are already transporting people.
It's Robovan.
Those things are already in operation in Miami, Seattle, San Francisco, Austin.
Really?
They exist. Yes.
Huh.
They're autonomous vans. They use them near the airports. So it's very cool looking, and I do think that those things are going to be very useful. But like it exists already, and it's on the road. So it's a new design. It's not really typical of Tesla to be that far behind because this is a prototype.
Yeah. Well, the stock fell 7% and no bounce in the 3 days since.
The car, you could see, it's a 2-door. What the fuck do we need a 2-door taxi for? What is that good for?
It's a prototype.
Not 2-door, 2-seat. No, it's a prototype of something they're going to build. It's a 2-seater. Take my family to the airport. I'll take 2, please. I don't really understand. Maybe a golf cart would be better. I don't really understand that. And then the other big thing that they did, and guys, I'm not like anti-Tesla or Elon. I think he's a genius, and I think the company and all of Elon's companies are doing insanely sick stuff. I'm just talking about the cab itself. They had the robots, and there's talk that these things were being teleoperated by people hiding in the bushes. I don't even know, like they're able to do some stuff but not others, but they just kind of wanted them to be.
What did Elon say these things could do? Like bartend and be your friend?
Yeah, I don't need either of those two things. Here's Gene Munster's tweet. This is him the night of. Mega AI use cases are getting real. I can't stop thinking about my interaction with Optimus. One of the several jaw droppers was when I asked it to speak Spanish and it didn't miss a beat. It was a person in the bushes speaking Spanish to you, Gene. Are you a tech analyst? My most important take. All right, blah, blah, blah. The next day, here's what he tweets. Reports that Optimus bots were teleoperator. Fooled me. Wish the full autonomy for Optimus was further, but still gave me a window into the potential around these. Dude, really?
What? You never been fooled before? Don't make fun.
I get fooled every day. Anyway, I'm not going to read all the analyst comments, but even the Tesla bulls were like, "This is not it." And Dan Ives defended the stock. He thinks that we're going to look back and see this as a historic announcement years from now. I'm not so sure. I think people were expecting the consumer app that's going to turn your existing Tesla into a rideshare vehicle while you're at work or while you're asleep. Of course, that's not going to happen now. If you've seen a Waymo vehicle, you know it's covered in sensors and cameras and equipment, and people's Tesla Model 3s in their driveway aren't. So how could it possibly be a robo-taxi? I almost don't even understand. They rallied Tesla 40% into this, like thinking that the app was coming. The app didn't come.
What app? Oh, to turn the... Okay, got it. I'm sorry.
So that the whole fleet becomes a robo-taxi, which probably he will be able to do someday, but we're like just not there.
Yeah.
And people thought we were there. So the biggest reaction was not in Tesla. Biggest reaction was in Uber.
Credit to you.
Full disclosure, I own it. And
Full disclosure, I sold it. Whoops.
Okay. I never believed this Tesla robo-taxi story. From the second he tweeted it,
You've been steadfast.
It seemed like a Hail Mary. Like we're years away.
Yeah.
And they sold Tesla off. I don't know if you know this. It was 80. It went to 59 in April when they first tweeted about this event. Now it's back at 80. Chart, please. Stock jumped 11% the day after the robotaxi event. And I'm going to say again what I've been saying. Uber is 150 million current users. They will be the demand that Waymo and eventually, maybe in 2 years, Tesla Cybercab will rely on to get to scale. The riders are already on the Uber app. If you have an autonomous taxi like a GM Cruise or a Waymo, just plug your network right into Uber's demand aggregator and instant business for everyone involved. So that's the way that I see the Uber opportunity.
You're not really. I would just say switching costs out of Uber in terms. Yeah, they've got the network, but like it costs you nothing to get off Uber and onto a different app.
Correct.
It's making the giant assumption that they can actually deliver.
Correct, but here's the thing. If the riders are already there and Uber is the best at connecting passengers with riders, if you need very quick usage on your autonomous fleet, because every day that fleet exists and it's not being used to capacity, you're burning money, you plug it right into Uber. And they've already struck a deal with Waymo. Yeah. So that's how I think this shakes out. I could be wrong, but this event was confirmation for me that's what it is.
You were 100% right this whole time. You and I were in a car speaking about this. I don't know if it was a year ago, and you were right. Okay. All right, let's talk about Nike real quick. So the new CEO started his job yesterday, and here's what he's inheriting. This blew my mind. Face. Global retail sales of sports footwear totaled $165 billion in 2023. $165 billion?
Yeah. It's wild.
What? It's a big number. That's up 23% from 2018. I'm sure.
Think about it. Think about how many people live on Earth, and almost all of them have 2 feet. Just saying.
That's true. Well, the other thing is that a lot of people are now buying sneakers more athleisure because they're not in the office as much.
Yeah.
So okay.
Or they wear them to the office.
So imports of athletic shoes, and in the U.S. we import 99% of our shoes. Imports of athletic shoes are up more than 10% year over year, compared to a rise of just 1% for all footwear. So athletic shoes specifically on fire, and Nike's not participating. They're being left in the dust. Why? Because they fucked up big time. They changed their strategy to compete with their partners, and it backfired in a big way. So in 2017, this is from the FT. In 2017, the industry leader announced an aggressive plan to shift its sales strategy towards a direct-to-consumer model, moving away from what it called mediocre retail. This opened up shelf space at chains like Foot Locker for other brands. And guess what? Other brands came on. Hoka, OnCloud, whoever. Like, so really not...
New Balance.
New Balance. Hot right now. So hot right now. So on their most recent conference call, tell me if this is good or not. Given our CEO transition, and with 3 quarters left in the fiscal year, we are withdrawing our full year guidance. We intend to provide quarterly guidance for the balance of the fiscal year. This provides Elliot, that's the new CEO, with the flexibility to reconnect with our employees and teams, evaluate the current strategies and business trends, and develop our plans to best position the business for fiscal 26 and beyond. To that end, we have also decided to postpone our investor day. Yikes. So
no, this is exactly what they should do.
No, you're right. So it's kitchen sink. There's bearish sentiment at Nike is at an all-time high, and strategically, I completely agree. As dumb as it sounds, no. Everything, get it out. So I just want to throw up some charts to talk about where they're at, courtesy of WAYT charts. So their revenue is down, and come on, you don't want this is Nike. You're Nike. Come on, fix your shit. You don't want your revenue going down. Total return compared to the S&P 500. Look at this, Josh. It is where it's been. It hasn't outperformed the S&P since freaking 2008. Next chart, please. So this is showing actually the comparison from October 2008 to today. Nike has underperformed the S&P 500. One of the greatest companies of all time over the last 15 plus years has underperformed the index. So I would say that bearish sentiment has never been higher, but I don't know that it's a buy either. I mean, this is a tough turnaround.
I bought a pair of Hoka's 6 months ago for the first time.
You love them, right?
I immediately bought 2 more. I have 3 pairs in 6 months. They fit. They're comfortable. They're great for everything I do. Nike is still getting by on selling retro Jordans, Dunks, Air Force Ones,
Air Max,
Air Max 95s, and they just like have not. They also have an aging fleet of signed athletes that people are not excited about, like Durant and LeBron and Giannis. And the shoes don't even look good. They're just like out of step with what's in style. I also think there's a decline. I also think that there's like kind of a transition in pop culture away from hip hop over the last year or two. And that Nike and Adidas, kind of both brands, like kind of really need that to be a bigger thing than it is right now. I think it's hurting them. Like outside of Kendrick Lamar's summer that he had calling Drake a pedophile, we went almost the whole year without a number one hip hop song on the pop charts. It's all about like it's the girls now running the show, like Taylor and Olivia Rodrigo and Sabrina Carpenter and Chappell Rowan, and then country music, and like just it's not Jordans and it's not Air Force Ones. Like that's just not what kids are wearing when they go to school. So I'm not talking about me. It doesn't matter what I think. I'm just talking about like pop culture in general has moved away from Nike basketball shoes and is moving. And I don't know when it stops, but it's just a really tough time right now.
Kind of wild. Is Nike the biggest, the most iconic retail brand in the world?
It's got to be top 3,
right?
Top 5. Yeah.
Who's bigger than Nike? And 16 years they haven't beaten the index.
Because again, they're resting on their laurels. They're selling retro designs from the 1980s and 90s. And during the pandemic, they had this surge of people that wanted to reconnect with their childhood, and they had like this nostalgia thing going on where everybody like was buying Nikes, and they had drops, and they had bots buying the sneakers, and it pissed off their clients. They stuck their middle finger up to Foot Locker, which was one of their most important channels.
Big mistake.
They thought that they would sell on Nike.com and the sneakers app and Amazon, and they didn't need a physical presence outside of their own
they thought
stores.
they could cut out their partners. This is like a case study of what not to do.
100%. So now they have to reconnect with the running community, which they lost to New Balance and On Cloud. They have to find a new in terms of pop culture. They have to get on a new wave, and they have to repair relationships with brick and mortar, and they have to do all 3 things at the same time.
So I am generally of the opinion that when you have like a global dominant brand that's down 50%, you just hold your nose and buy. But this is going to be tough.
In the chat, Speedrunner is saying Caitlin Clark Nike deal will pay off. I'm sure they'll make money on that. I don't know if that's big enough.
Okay, so
it's not the wave right now.
Yeah,
I don't know what else to say.
All right, Vision Pro.
We can't spend a ton of time on this because we're already. Apple has not disclosed any sales figures for the Vision Pro, but analysts say, they cut their first year Vision Pro shipments to between 400,000 and 450,000, down from 700 to 800,000 units. Nobody will make apps for this thing. This is one of Apple's biggest product launch flops ever. The new apps for the Vision Pro have slowed every month since the launch in January. And some of the biggest virtual reality software developers are just saying no, they don't want to do it. And it's a chicken or an egg problem. If the apps aren't there, people don't want the device. And people aren't going to make apps if they don't have the device selling well. So this is like really crazy. The strategy was they're going to make a premium version, sell it for $3,500, and count on developers to come in with killer apps for it. And it sort of didn't work. Here, only 10 apps were introduced to the Vision App Store in September, down from the hundreds released in the first 2 months. There are 1,770 apps available for the App Store. And this is bad. In 2008, for the first iPhone, there were already 50,000 apps. There were 10,000 apps for the Apple Watch inside of the first 6 months when it first came out. Meanwhile, Meta has 74% share of the, what are we calling this? The visor market?
No,
it's not
so
wearables.
Apple calls it spatial awareness. What does Meta call it?
That's a bad name. augmented reality.
Yeah.
Meta has 74% share. Apple is not used to playing from behind. And now Meta just teased something called the Orion, which is a step above the Ray-Bans.
They're fucking them up.
Yeah. So, we said Apple owns the handheld version of the internet. No question. They own it. All the profits of the handheld version of the internet have gone to Apple. Meta is the front runner for the augmented reality era. And not many people would have predicted that 3 years ago.
Definitely. Yeah.
That's the story there.
Yeah.
All right. Let's make the case very quickly, and then I know you have a mystery chart for me.
What are we doing?
Avoid falling knives. I'm making the case that this is, and I'm guilty of this. I have a couple of stock. I have maybe one stock right now at a 52-week low. We don't want to buy falling knives.
No.
Just if you want to roll with me, if you want to be down with my posse, this is not what we do. We do not scour the multi-year low list looking for opportunities. It's just not the game that we play. Here's Boeing. This is such a piece of shit, this stock. Great company, blah, blah, blah. I know. Don't get mad. It's only up 43% over the last 10 years versus 275% for the S&P 500. It is embroiled in constant problems. It almost never seems to stop. It's honestly one of the worst blue chip 3-year performances I have ever seen in my time in this business. And I don't really understand how you fix this. It's cultural, but then it's also execution. It's constant leadership turnover. And this is happening against the backdrop of airlines making more money than I think they've ever made and placing tons of orders for planes. This stock can't perform. What does it do in a recession? So I don't really know what the solution is here. I want to show you one more. This is somehow worse. This is Walgreens Boots Alliance.
Dude, I just, on the name alone, I reject it out of hand.
Garbage name.
Walgreens Boots Alliance? Who thought that was a good idea?
They bought some stupid British thing. It used to be WAG was the ticker, WAG, and this stock was a performer.
Bring back WAG. Change the ticker.
Well, at this point, it looks like it's going to the pink sheets. Walgreens was always the best operator in the pharmacy space. They were always better than CVS. Always, always, always. And now somehow they're worse. This stock is down 76% over the last 10 years. And again, the S&P has more than tripled. It's like a nightmare wrapped in a phantasmagorical debacle. And does this go to $5? I don't even know how you pull the stock out of a tailspin like this. It's beset on all sides by competition and secular reasons why people are not going into these stores.
I love this advice. I love this advice. If you're going to catch a stock in a downtrend, which I have done and I unfortunately continue to do, at a bare minimum, wait for a higher low.
Oh, which I'm so glad you said that, because people are in the chat shit-talking my Pfizer holding. Pfizer has been flat for a year. That's not a falling knife.
No.
It's not good.
No, it's a shitty stock. It's not a falling knife.
It's
no,
not.
Big difference.
How do we define falling knife? Can we
Yeah, I'll tell you. A stock that continues to make new 52-week lows.
Yeah, with no upticks along the way.
If you have a 52-week low every month for the 16 of the last 18 months, that's a falling knife.
Yeah, I want to do something a little bit. I want to actually define falling knife.
Wait for a higher low.
Not now, but
how about this? If you've been below your 200-day moving average for 180 days, whatever it is, we know what a falling knife is.
Right, so that's not a buy signal.
No, it's the opposite.
It's the opposite. Have trouble with this.
I love.
Used to.
You know what?
I don't
honestly, buy low, sell high has cost investors more than any other shitty phrase that's ever been invented.
Now, people will say, "Well, wait a minute. Meta was a falling knife." You know what? Meta was a stock in a crash. You didn't have to catch the low to make money on Meta.
I literally caught the bottom, not to brag.
I know you did.
Yeah,
I know you did. And I don't like it. I don't like that you did that. It's not repeatable.
No, but you buy panic. If people are on TV crying, you could buy that. You buy absolute panic.
That's not what this is. This isn't panic.
But falling knife, A falling knife is because the business is in secular decline. There's a big difference between secular decline and a huge overreaction when a blue chip name gets down 22%. Like, there's a difference. You could buy panic. You could buy panic. You can't buy a falling knife.
Yeah, Chirag Nirmal is saying Starbucks. Yeah, that was a panic. That was not a falling knife.
Bought Starbucks.
That was not a falling knife.
I bought the panic.
We're going to define this term next time we
So that's what I do. I buy panics all the time.
All right,
but I don't buy falling knives.
Give me a mystery chart. I got pastrami on the counter waiting for me.
Here we go. All right. So these are 2 sector ETFs. One of them goes all the way back to the beginning of the sector ETFs, and the other one came about a bit later, but it's the same sector, just maybe a little bit different. That's a lot of clues. Anyway,
these are wait, they're the same sector, just 2 different ETFs on the same sector?
Yeah, a little different flavor. They both
want me to guess both?
It's the same sector. They both closed at a 52-week high today. It's confirmation. The big ones, the medium-sized ones, it's all working.
Oh my. Sector, like U.S. stocks?
Sector, a U.S. sector.
All right. I'd like to solve the puzzle.
Go ahead.
It is IHB and what?
It is neither of those things.
It's not home builders?
No.
All right, that was a good guess though, right? XBI and IHB.
Not bad. Look at 2007, 2008. Something happened to the sector.
Ooh. All right. It's banks?
Pretty much.
Okay, so is one XLF?
Yeah.
And is the other one, what's the other financials sector ETF? Give it.
It's right there on the screen. It's the equal weight.
Oh, what is it?
It's the equal weight. Yeah, 52
I didn't know that existed. I didn't even know that existed. I never would have gotten it.
All-time highs.
Yeah. How do you like that?
The whole time. The all-time.
How do you like that? Hey, everybody. Thanks so much for watching the show. Did you know that tomorrow morning is Wednesday, which means another all-new edition of Michael and Ben and Animal Spirits, my favorite podcast. In addition, Duncan and Ben are doing an all-new edition of Ask the Compound, and that is on YouTube during the day Wednesday. Look for the alert, and of course, we'll be back at the end of the week with the Compound and Friends. Thanks so much for watching tonight. We love you. We'll see you soon.